Look, the game is completely rigged against anyone relying on a standard corporate paycheck, and the financial advice you are consuming on your feed is actively keeping you broke. The crowd is out there desperately waiting for interest rates to drop back to zero so they can finally buy a house or watch their speculative tech options moon. But I am here to tell you that the zero interest rate era is dead and it is not coming back. We are staring down structural long-term inflation driven by massive geopolitical supply disruptions, skyrocketing federal debt, and fundamental shifts in the global supply chain that you cannot just flick a switch and magically fix overnight. Most people are playing a game that no longer exists, using an outdated downsetting-isher playbook in a world that is completely flipped on its head. I get it. It is incredibly frustrating when you work 6 or 12 hours a week, stack your money, and still feel like the purchasing power of your bank account is melting away faster than you can earn it. You look at the housing market in major cities, you look at your daily grocery bills, and it feels like the goalposts of financial freedom are being moved further away every single day. But crying about a Keygen-shaped economy where asset holders win and wage earners get crushed is not going to pay your bills or build your wealth engine. I know exactly how it feels to look at a chaotic market and want to make a desperate move to catch up, because when I first started, I made some absolutely massive, stupid mistakes. I remember thinking I could outsmart the market by chasing hyperds and leveraged options, trading garbage hype stocks, and trying to time the absolute top and bottom of volatile tech trends because I wanted that fast cash. Oh shit, I lost thousands of dollars fast, feeling that sick pit in my stomach, realizing that I was just gambling under the guise of investing. It was a brutal, necessary wake-up call that forced me to stop acting like a degenerate gambler and start operating like a systematic, data-driven capital allocator. I had to force myself to realize that real wealth is not built by catching a single lightning bolt in a bottle. It is built through ruthless personal discipline, living significantly below your means and establishing a mechanical, automated wealth loop that exploits market structure instead of fighting it. Let us break down exactly what is happening under the hood of this economy right now without any of the academic nonsense or formal economic jargon you hear on the news. The massive run you are seeing in the major stock indexes is not purely a reflection of explosive corporate health. It is a highly reflexive phenomenon driven by the sheer mechanics of passive investing. When half of the entire stock market is driven by passive exchange-traded funds, a massive influx of capital automatically forces the top component stocks higher, which in turn pulls the entire index up faster, creating a self-reinforcing feedback loop. At the exact same time, the banking system has seen massive asset growth, giving institutions a wall of liquidity that they have to put to work, which flows directly into financing major assets, stock buybacks, and chasing speculative mania. If you are sitting completely in cash, you are effectively volunteering to let inflation erode your hard-earned capital, while the asset-owning class watches their net worth adjust upward with the expanding money supply. So how do we navigate this reality without losing our minds or gambling our future away on highly speculative assets? We build a resilient, multi-layered asset portfolio designed to capture systemic growth, generate consistent cash flow, and hedge against severe structural inflation. For the core foundation of your wealth engine, you want to rely on broad market index funds like VO or VTI, which track the largest American companies, or the total stock market. By setting up an automated BI and weekly dollar and cost averaging strategy, you are completely removing emotion from the equation, buying fewer shares when the market is expensive and aggressively accumulating more shares when the market takes a dive. To supplement that foundational growth, allocating a portion of your capital into high-quality dividend growth funds, like SHD, provides a consistent, compounding cash flow stream that reinvests automatically, creating an exponential snowball effect over time. But we also have to recognize that commodities like physical silver are playing an entirely different game right now, acting not just as a monetary store of value but as a critical industrial asset. The global demand for silver is surging due to massive structural developments in technology, including advanced electronics and solid-state batteries, while the actual physical mining supply remains highly constrained and inadequate to meet industrial needs. When you combine a foundational equity core with an inflation-resistant commodity allocation, you create a portfolio that does not care about short-term political narratives or whether the central bank decides to cut or hold interest rates. Look, the ultimate differentiator between the people who build true financial sovereignty and the people who stay trapped in the wage-earning loop is purely behavioral. The crowd panics when the headlines turn red, they stop their investment plans at the exact moment assets go on sale, and they FOMO back into the market at the absolute top when everything feels safe again. You need to train yourself to welcome market volatility as an absolute gift, an opportunity to acquire elite cash-generating assets at a massive discount while the rest of the world is paralyzed by fear. Stop waiting for an external savior. Stop waiting for the housing market to magically crash back to downstanding levels, and stop letting inflation dictate your financial destiny. Fix your cash flow, aggressively widen the gap between what you earn and what you spend, and channel that surplus capital into a systematic, long-term investment engine that runs completely on autopilot. Stay incredibly focused. Block out the daily macroeconomic noise. Keep stacking your assets block by block, and let time do the heavy lifting. Let us get real about what happens if you choose to ignore these structural shifts and just keep doing what everyone else is doing. You are going to watch your savings account get quietly eaten alive by an inflation rate that is consistently higher than the numbers they show you on television. The traditional path of saving money in a standard bank account and hoping to buy a beautiful suburban home on a modest salary is fundamentally broken because the supply of real estate is constrained and the supply of money is expanding. When the federal debt is accelerating towards dollars, the systemic response from the state is not going to be a massive fiscal tightening. It is going to be a continuous devaluation of the currency. This means that asset prices will naturally move higher over a multi-year horizon, not because the underlying businesses are suddenly twice as productive, but because the dollar itself is worth less. If you understand this baseline reality, your entire perspective on risk completely transforms. Suddenly, holding massive amounts of unallocated cash becomes the riskiest move you can possibly make, while owning high-quality, productive assets becomes the safest. I remember when I first crossed the $99 net worth milestone, and I expected to feel like a completely different person, or like all my financial anxieties had vanished. But the truth is, nothing changed outwardly. My daily lifestyle stayed exactly the same, and I was still driving the same vehicle and making my own coffee at home every single morning. The only thing that changed was the profound sense of mental clarity and leverage that comes from knowing my automated wealth engine was working for me while I slept. That milestone was not achieved by picking a winning meme stock or getting lucky on a speculative option trade. It was achieved through the boring, repetitive execution of automatic BIs and weekly transfers into index funds. It was achieved by cutting out the useless subscription services, avoiding the trap of lifestyle inflation every time my income increased, and looking at every dollar as a potential soldier that could fight for my financial freedom. The modern financial media wants you to believe that investing is this incredibly complex puzzle that requires an advanced degree from an Ivy League school and a subscription to an expensive terminal. They use dense terminology, backwards-looking economic models, and confusing charts specifically designed to make you feel inadequate, so you will hand your money over to them and pay their high management fees. But here's the deal. The most effective wealth building strategies are beautiful in their absolute simplicity. If you can consistently allocate 60% of your investment capital into a broad market fund, like VO % into a dividend growth engine, like SHD, and 60% into a strategic commodity play, like physical silver or a low-cost growth fund, you are already outperforming the vast majority of active money managers over a sheer year timeline. You do not need to sit in front of a computer screen all day long tracking every minor tick of the market or trying to predict what the central bank chairman is going to say at his next press conference. The market is going to hiccup, it is going to have massive pullbacks, and there will be entire quarters where your portfolio balance looks lower than it did the month before. When those moments happen, the untrained investor panics, opens their app times a day, gets consumed by anxiety, and eventually capitulates and sells everything at a loss. But as a systematic allocator, you look at those exact same red days and you see a massive, beautiful clearance sale on the best corporations in the world. You need to develop the psychological fortitude to view market drops with the exact same excitement you feel when your favorite clothing brand or tech gadget goes on a 80% discount. We are entering a highly volatile decade where geopolitical conflicts, energy shortages, and major structural shifts in manufacturing are going to create constant economic noise. The people who try to trade this noise are going to get completely wiped out by the whipsaws of the market, losing their capital to fees, taxes, and bad execution. The people who win are the ones who can maintain a state of total emotional detachment, trusting the long-term compounding power of global equities and hard assets. Look, nobody is coming to save you, the government is not going to fix the housing affordability crisis, and your corporate employer is not going to hand you a massive raise out of the goodness of their heart. Your financial sovereignty is entirely your own responsibility, and it starts with the absolute standard of behavior you set for yourself today. Stop comparing your lifestyle to the fake wealth you see on your social media feed, because most of those people are drowning in hides and interest consumer debt just to maintain a fleeting image of success. Focus on building real, silent wealth, the kind of wealth that does not need to show off because it is backed by a fortress of cash generating assets and an unbreakable mindset. Keep your living expenses low, constantly look for ways to increase your primary income, or develop a secondary cash flow stream, and funnel every single extra dollar into your automated wealth loop. Every time you resist the urge to buy a useless luxury item or an expensive lifestyle upgrade, you are actively buying back a piece of your future time and freedom. That is the real objective of this entire journey. It is not about buying an expensive sports car or showing off to people you do not even like. It is about gaining absolute control over your time and your choices. It is about being able to walk away from a toxic work environment, take care of your family without stress, and live your life completely on your own terms. So take a deep breath. Accept the reality of the economic environment we are dealing with, and commit to the long-term process without looking for shortcuts. The journey is long, the macro noise is loud, but the mathematical reality of consistent compounding is completely undefeated. Let us break down exactly how you can implement this starting this exact week without getting overwhelmed by the sheer scale of the global economy. First, you need to establish a rock-solid emergency fund that sits completely separate from your investment capital, containing $10 of absolute bare and minimum living expenses. This fund is not there to earn a massive return, it is there to serve as a psychological shield so that when real life happens, whether it is a medical emergency or a sudden shift in your employment status, you never have to touch your long-term investments. Once that shield is in place, you immediately look at your main bank account and establish an ironclad, unchangeable automated rule that triggers the exact day your paycheck arrives. If you leave your investment capital sitting in your main account with the intention of just investing whatever is left over at the end of the month, you are setting yourself up for total failure. The human brain is hardwired to spend whatever liquidity is easily accessible, a phenomenon known as lifestyle creep, where your desires naturally expand to meet your available cash. You have to trick your own psychology by paying yourself first, ensuring that your investment capital is pulled out and deployed into your core assets before you even have a chance to think about spending it. Imagine your wealth-building journey as constructing a massive corporate skyscraper. Your core index funds like VU form the deep steel and reinforced concrete foundation that can withstand a Category WU financial hurricane. Your dividend growth components like SAG represent the recurring rental income from the offices inside, providing a steady, reliable stream of cash that keeps flowing regardless of weather conditions. And your strategic commodity or technology plays represent the cutting-edge architectural design on top, capturing explosive upside when global macro trends shift in your favor. You cannot build a skyscraper by starting with the roof, and you cannot build a sustainable investment portfolio by jumping straight into high-risk, speculative assets without a foundation. I see so many young guys in my comments who have $10 in a broad market fund but are holding thousands of dollars in highly volatile, unproven digital tokens or triple leveraged tech ETFs. That is not investing. That is an absolute financial death wish. And it is the primary reason why the wealth gap continues to widen between the elite allocators and the emotional crowd. When you own an index fund like VU, you are literally owning a fractional piece of Apple, Microsoft, Amazon, Alphabet, and Berkshire Hathaway, the most powerful cash-producing machines in human history. These corporations employ the brightest minds on the planet, possess massive pricing power that allows them to pass inflation costs directly down to the consumer, and operate on a global scale. When you buy a broad index, you are betting on human ingenuity and the collective drive of the global workforce to solve problems and generate profits over time. That is a bet I am willing to make every single day of my life. And it is a bet that has consistently rewarded patient investors for over a century. Do not let the short-term market corrections shake your confidence or make you question your strategy, because a market correction is a natural, healthy mechanism